Welcome back, everybody. It's May 2nd. The energy blockade is becoming our new normal, but we now have a massive squeeze in copper, a sticky inflation hitting the Bank of Canada, and Q1 earnings exposing the true pricing power of our oligopolies. Let's get straight into the stories. Copper prices are ripping higher, breaking out their historical ranges alongside oil and gold. Canadian heavyweights like Teck Resources and Ivanhoe mines are seeing massive volume and price action. We're seeing a severe global supply shortage collide with a massive new demand shock. The AI data center buildout. Data centers require exponentially more copper for power generation, cabling, and cooling system than traditional tech. Canadian-based metal equities are outperforming, pulling the TSX Materials Index higher, and proving the market is rotating focus beyond just precious metals and oil. I suspect this is the beginning of a structural commodity supercycle, not just a short-term spike. If global AI infrastructure spending continues at this pace, copper deficits will only widen, making companies like Teck Resources cash flow generators for the foreseeable future. April's inflation data is practically guaranteed to run hot. The Bank of Canada is now trapped between fighting inflation and saving the highly leveraged Canadian consumer. With crude oil acting as an unavoidable input cost across the economy, the oil premium is bleeding into the price of everyday goods. The Bank of Canada wants to cut rates to prevent mass defaults on mortgage renewals, but doing so right now will send inflation spiraling out of control. The bond yield remains elevated as the market prices out any hope of summer rate cuts, putting immediate downward pressure on heavily indebted, rate-sensitive sectors like REITs and Utilities. Expect the Bank of Canada to be forced into a hawkish hold. They simply cannot afford to cut rates while energy is driving up CPI. We're entering a higher for longer period where Canadian consumers will have to absorb the pain to keep the currency inflation from breaking. Q1 earnings for the big three, Canadian groceries, Loblaws, Metros, and Empire, are showing highly resilient profit margins. They are successfully passing on higher transportation costs and fuel costs directly down to consumers. These three companies control roughly 60% of the Canadian grocery share market. This oligopoly status gives them immense leverage. Unlike smaller retailers who have to eat up supply chain costs, the big three can maintain their margins by simply raising shelf price without fearing losing customers to cheaper alternatives. Canadian staple stocks are acting as incredible defensive inflation hedge for portfolios, but it comes at a direct expense of the average Canadian disposable income. This is widening the K-shaped economy. Divergence is going to accelerate. The grocery stores will maintain their defensive strength on the TSX, but because consumers are spending all their cash on food and fuel, discretionary retail might struggle this summer. The TSX index remains volatile but resilient this week, heavily supported by our resources and consumer staple sector, masking the weakness in the broader economy. This is Union Stock. We don't guess, we analyze. See you next week.